Okay, so today got two main topics that we want to cover. One is a continuation from our previous two discussions, which is around investing process. So I think today is our last part, and I do want to talk about uh, constructing an active portfolio, and then what are the things that we could do while we are holding the stocks. And then finally, if we have to divorce the stocks, sell the stocks, what are the reasons to do it, right? So that will cover the whole investing process that we started discussing. Today is the third session. And of course, this is earnings season, so we'll continue to review some of the earnings. The current week was big from earnings from a lot of tech companies. So we'll want to talk about that. As always, we'll start with a little bit look at the macro side, open for any questions, anything else you want to discuss. So we'll take it up from there. Okay, anything else you guys have in mind? All right, sounds good. All right, so let's start with the bigger picture first before we get into the weeds. So starting with the bigger picture, this week kind of was a sea of red, I would say. I think majority all the big indices they were down for the week, and the two big ones, which is the SPY, which gives a health of or the stock prices of top 500 companies, and QQQ, which is on the tech side, or the Nasdaq, both have now entered into the so-called correction territory, right? So if you go back and look at both the SPY and Nasdaq, they pretty much peaked in end of July, and since then the August has been a weak month, negative month. September has been negative month, and we are what, today is 28th. We got 2 more days for trading in October, and until some miracle happens, to me it looks like even October might turn out to be a negative month, right? So we had some great runs starting from at the start of the year all the way till July, and now we have given up, at least both in case of the tech, Nasdaq, as well as SPY, we've given up more than 10%. So essentially we are back into the correction territory, right? Even with that, I believe SPY is still up 7% for the year, so not that bad. But yeah, once you're on the top, once you look at your portfolio and see, wow, I'm like up 17%, and now you're looking at you're up only 7%, so that hurt a bit. So I think that's what's going in the market. So essentially all the media is all talking about how bad these months have been. But if we zoom out, I would say 7%, 8% for a year, not that bad, right? For all our market. Now, depending on what kind of a stocks you hold in your portfolio, individual situation could be different, but from a market side, still okay. So stocks were all down, and if you look at the others, like Dow Jones ended a week in negative. SPY, like I said, ended a week 2.5% negative. Nasdaq, which is tech focused, was negative. Even outside of US, MSCI, this is the rest of the world, is negative. 10-year treasury also ended up negative. Even oil ended up negative, right? So there were almost, I would say, no place to hide in this week. Most of the every market, whether it's a US, not, or any other sector, probably most of them were negative. So now, like I said, we have entered into the correction territory, and correction is technically termed as if you are 10% lower than the recent highs, then it is considered to be in a, every time a stock moves to 10% lower than the recent high, it's a correction territory. It's not in a bear market yet. Bear market is considered as a move of 20%, but it is in the correction. And majority of this was driven by, I would say a mixed earning report. We're going to look at some of those earning reports later in the session, but these Magnificent Seven, they command a lot of weightage in these indices, and when we don't see them performing, look at Meta. Google was surprisingly, Google was like, they had their worst day since I think 6 or 7 months. Google is down 10%, and these big companies have a huge weightage. So not surprised then that when we don't, when companies like Apple and Google, when they don't perform, it's hard for big indices to perform, right? If you look at Apple has been down since from 180 in 2 weeks, it's down to 168, right? And Apple is like $3 trillion company. Same as if you look at Google is OGL. Google is $1.5 trillion companies. So these big companies cut both ways. I think Meta also didn't have a great week. Meta is $760 billion. Let's look at Tesla. We reviewed Tesla's earnings last week. Tesla is down significantly, close to from 270. It's now almost 210. So that's almost $700 billion company. So these Magnificent Seven, when they go up, they help the indices. And as we have looked earlier, majority of the stock, I think, if we take out these Magnificent Seven, the rest of the 493 haven't done pretty much for this year. So all the gains have accrued because of these Magnificent Seven. And now the way they give the gains, now they are taking away the gains, especially looking at from what happened to the stocks in last week. There's a question, what's the difference between Google A and C? Why don't they merge it? Probably there may be a difference in voting rights, I guess. I haven't looked at, but Google is notorious for having multiple classes of shares. I haven't really looked at difference between A and C. I know they have two tickers. One is GOOG and GOOGL, but there is no arbitrage between these two. These two ticker symbols, they almost track, penny by penny. It could be some difference in the voting rights or something. I don't know. I haven't looked at that. So Magnificent Seven giveth, and now this week they take it. But like I said, we are still 7.8% up for the year for SPY. Not bad at all. But what hurts is that we have a drawdown of almost 10.6% from the recent highs, and depending on where you enter the market this year, you could have a little different feeling, but I'll take it, like 7.8%, and we are in 10 months. I'll take it any year. So that's overall. Now looking at if the market is in correction, is there a further hope or not? I did found some good reading. I do want to go through that. We'll be happy if you have questions, comments? Let's see. Let's make it a little more interactive. So despite what has happened in the market, economy is still resilient. And I think that may be one reason why the markets are like a little jittery. So GDP numbers came out this week, and GDP is strong at 4.9%, which is ahead of our estimates. And it was like twice the second quarter. So despite whatever happening in the world, you can't keep Americans away from spending, right? Consumers are still spending. GDP is growing still strong, 4.9%, and mostly driven by the consumers. There is some portion which you could see came from government spending, and a little bit on the housing side, but largely driven by the consumption from consumer side, right? Inflation continues to moderate. So while strong GDP could be a negative factor, and because nowadays in the market we are looking at good news for the economy is bad news for market, because then Fed won't, Fed will continue to stay high, continue to keep the rates higher for longer. So while the good economy, strong GDP, you might think, okay, bad for the market, but the other side, we are looking at inflation, which continues to moderate. Right? We had a stronger than expected growth. We had and a lower unemployment, but inflation continues to trickle down. Right? The PCE index came out this week, which is what Fed looks at for deciding the rates. It has trickled down a little bit. It's like from 3.8% in August. Now it is down a little bit to 3.7%. Still long way to go. I mean, the target is 2%. And this week, even on the Europe side, I was listening to ECB chairperson Christian Lagarde, and even in Europe, the target is still 2%. I don't know why they're still stuck at 2% of the target, but it is what it is. So it is still from a 3.7%, bringing it down to 2%, still long way to go. But I think it is much better than last year. We were at 5.6% around the same time, and bringing it down to 3.7%, so far good. Third, Fed might be near the end of the rate hikes. If we have a Fed meeting coming up, FOMC meeting is in this week, and if it keeps the interest rate unchanged, because the bond market is actually doing the work what Fed is supposed to do. If that is the case, and then Fed probably will not increase the rates. I think market is pricing in no further increases in the rates, and then maybe some rate cuts starting in Q2 of 2024. So if Fed is close to near the end of the rate hikes, that will bode well for the stocks, for other financial assets, for real estate, some crypto, NFT, because now we reached the peak of the Fed rates. What else? Valuations have become better, right? Now we had a pullback. Now suddenly, because after that pullback, the PE of overall market is better. Is now at a 17.4, still on the higher side, but I think it's much better than 19. Right? But the 17.4, if we break it down into the components and see which components of SPY are contributing to 17.4, mostly it is driven by the Magnificent Seven. So let's look at those Magnificent Seven and see what their PE ratios are. So this is what Google is trading at 23, Tesla is trading at 66. NVIDIA is better because, oh, sorry, NVIDIA forward P is better. NVIDIA is trading at almost 100. So you get the point. Meta is trading at 26. So essentially, when these magnificent seven big ones are trading at such a huge multiples, and these are the big, these companies have a big weightage in the overall index. No wonder that the index is trading at 70.4, right? If you look at equal weighted SPY, in which the weightage is not, because if you're a bigger market cap, you don't get extra weightage, that is 14. And the Russell 1000 value index is at 13, which is pretty fair, right? So 13 and 14. So depending on where these big magnificent seven moves, let's see what NVIDIA brings in. When is NVIDIA reporting results? To NVIDIA, oops, what happened to, okay, let's, there we go. Okay, NVIDIA is still far away. It's on 21st of November. So we'll see. Now, the next week, we got Apple reporting result. Even Apple is a little expensive side. So looking at Apple is at 28. So few more big companies yet to report the results, and then we'll see where the market goes and where the PE goes. See a couple of comments. Credit card interests are on the rise, 100 billion, which is huge increase. Yeah, and I think there are a few charts that I saw which is talking about the delinquencies in credit card has been the highest that we have seen, right? But consumers are still spending. So does it really, given until here's my thesis, until people start to lose job, until we see the unemployment ticking up, I don't worry much about the credit card interest rates are rising. I think people will stop spending or cut back once they lose the main source of income. Right? Steve said forward P is actually up because the next year growth rate is getting cut in half. Steve, are you referring to the overall SPY forward PE? At least on this, okay. At least on this quarter, the earnings are actually ticked up higher after the 2 quarters of negative earnings. This Q4 market expectation is that Q4 will be better. So I don't know what's the forward PE for the next year of SPY. I don't have that number though. Shashank is asking, what would be the best PE to consider while investing in stock? There is no one answer to it. Because it depends on what kind of a stock it is. Growth stocks generally command high PE. If you are looking at cigar butt kind of investing, then you look at a very cheap stocks, right? But then your upside is also limited. So there is no one straight answer. You always have to compare with, see what the market is paying for the peers, and then see, right? So when we're looking at the overall SPY on SPY, generally 15, 16 is where it's been a fair, on an average, that seems to be a fair one, right? But if interest rates goes further high, then that will suddenly start to look expensive. So there are multiple things that impact the PE. So I really don't focus just on PE. Though traditional valuations does consider PE to be the sole factor. I look at a lot of other stuff. In some cases, maybe I look at a cash flows than just a PE, just the earning. Oh, so forward is about 20.3. Yeah, so that will become, I don't know how it can sustain 20.3. Only, maybe let me put it the other way. The only way it would sustain 20.3 is when if the Fed starts to cut interest rates next year, which is what is expected. Only then I expect that, the more money will start to move into the stock, and probably we will pay up for the stocks. With current interest rates like 5.5%, it is tough. It's tough to justify these high PE multiples. SPY is at 3,800, it will be 16 point. Yeah, so 20 point with the 20.3. Okay, SPY is 3,800, so it will be 16.8. Yeah. So this is another interesting chart I saw. I have yet to find out how to make use of it, but now everyone is watching what Fed's gonna do, right? Either they will increase the rates, or they will keep it same, or they could decrease it, right? So there's this interesting chart looking at what will the impact on the bonds for 1% rate increase or 1% rate decrease, right? So let's look at the 10-year and 30-year. So for 10-year, as you guys know, with the increase in the interest rates, bonds generally fall in value, and with the decrease in the interest rates, bonds go high in the value. So if Fed reduces the interest rate by 1%, 10-year Treasury could gain 12%. But if Fed increase the interest rate by 1%, the 10-year will have negative 3.4% interest. Now, looking at 30-year, which is, it'll be 20.9% upside if the rates are reduced, and 11.4% downside risk if the rates are increased by Fed, which I don't think Fed is going to increase much. I mean, I don't know, but given where we are, market is not expecting Fed to increase any further interest rates. So looking at 10-year, the risk to reward ratio is pretty tempting. Right? It's like more than 3x. So the next thing is maybe I need to find out, okay, which are the 10-year treasuries or ETFs. Maybe we should search for it. 10-year treasury ETFs, right? Because that risk and reward ratio is pretty tempting. The TLT is 20-year plus. I think if I remember correctly, TLT is 20-year plus. So looks like IEF seems to be, this is BlackRock iShares. That's 7 to 10-year. That sounds good. Yeah, so probably this, so let me see, IEF. I mean, all the bond funds have been decimated, or bond ETFs, longer duration have been decimated this year, right? TLT has been cutting, is down 23% for this year. TLT is 20-year plus, and what did it find? IEF. IEF is down 6-7%. So you may want to look at this bond if you agree with this, right? Something to just keep an eye on. I am feeling interested in this one. And what's the yield? IEF yield. Does it say the yield? QCPT volume. 12-month trailing yield is 2.91%. So 30-day SEC is 4.69%. So you have a 4.69% yield, plus there is a possibility of another, if not even if 12, because Fed is not going to cut 1%, but maybe some portion. So that is really, I would say, tempting, right? 5, 6, 7% with almost zero risk. So I am tempted to look at 10-year bonds. I mean, I have some of the treasuries that will be maturing on 7th and on 15th. I may think to roll them and probably look at IEF as an investment vehicle. This does look a little tempting. Not a financial advice. You should look at when do you need the money or not. But to me, 4.69% yield plus an upside chance for a capital appreciation, that's when the SPY is returning 7.8%, but with all the risk in that, why would I take that? Stacey, if you can lock in 8% for 20 years, you could be safe for retirement. Yeah, and now there may be ways to find, if not 8%, at least 6, 7%. I think some of the corporate bonds, high yield bonds could give you 8 to 10%. These, we never had these times earlier, but it's only in last 12 months that we have a situation where you can actually get 5.5% risk free. The situation may not last longer, but yeah, what is it, right? Make hay while the sun shines. So before this goes away, if you want to lock in 4%, 5%, 6% for next 10, 20 years, there are opportunities. And these are risk-free. I mean, US treasuries are risk-free. Steve say that TLT's SEC 30-day yield is 4.65. If you sell 80 put and get assigned and sell immediately 1-year call, you will get 8%. Yeah. What else? We talked a little bit about earnings. So after 3 consecutive negative quarters, earnings have rebounded. And what I was reading is that it is expected to improve, but we'll see how it goes. Increase in oil prices. This is really tough to look at, the oil prices. After we saw a little bump in the oil prices after the Middle East conflict, and then it's back down to nothing much change, right? WTI is still floating between 80 and 90. Looking at if Iran get involved in the conflict, then the macroeconomic and the oil experts are talking about 120 barrels. But I've heard these numbers before also, so I'm not backing up my truck on oil. I'll still continue to work on the ETFs that I hold. But surprisingly, we haven't seen big movement in oil, right? Which deems good for the overall economy. Cheaper energy is good for low cost production. Let me put it that way. And investor seems less complacent. there have always been a cases of, investor euphoria, and then from a euphoria you get into pain and then sorrow and despondency and then depression. But right now, looking at now AAII, American Association of Individual Investors, 43% have now moved into bearish. So I don't see any euphoria over here, right? Euphoric situation will be where majority of are bullish. And if you look at fear and greed index, that has now moved into extreme fear. Historically, the extreme fear situations have provided some good buying opportunities. Again, not a financial advice, but it's a time to go shopping when the things are at discount. Right? Warren Buffett say it's the best time to buy is when there is a blood in the market. Right? When there is extreme fear in the market, when the baby is being thrown along with the bath water, that's the time to go and get some good stocks at some good discounts. So yeah, from this perspective, it's not that everyone is gung-ho and gaga about what's happening in the market. No, it's little cautious. Next one I want to share is so we had a negative August, negative September. We are closing down on a negative October, but could there be a seasonal Santa Claus rally? And we got 2 more months to go. The other thing, the October is generally negative also for tax loss harvesting purposes. Many mutual funds, they finish their year and in October, and so if they have to take any tax losses, etc., you'll see a lot of a selling pressure in October from that perspective. So next 2 months, which are generally on an overall a seasonally positive months, could this November and December be those? If you go back and look at the history, since 1945, which now we are looking at almost 80 years of history, right? November, 2/3 of the time, November has been a positive month, right? And 3/4, 75% of the time, December has been positive month. Now these are, it's not to say that this November or December will fall into this, but seasonally, last 2 months are generally better for the stock, for the stock market. But we have had 2018 December, when the market like bottom fell out from the market and the stocks were hammered. I have no visibility. I don't think anyone has a visibility of what might happen in November or December. But just because I just don't want to go against the tide and liquidate a portfolio, I don't want to take any of those decisions or go too much hedged just because of, hey, we generally have a seasonal tilt in the market also. And I said, why airline stocks are all-time low even when travel demand is so high? Airline stocks are always difficult to make money. I don't think anyone have made money in airlines. I've not followed airlines, but I think the Delta, they had some issues in recently. But okay, so international flights. But generally, airlines have been a tough place to make any money, right? Probably we would have saved a lot more money if there were no airlines, I put it that way. Many investors have tried to make some good money in airlines. Over the long term, it's just, it doesn't work out. It's a bad business from an investor perspective. There will be periods when they will do good. Overall, not a good for portfolios. Delta is self-inflicted. Yeah, something happened around Delta. It was in the news. I'm not close to that. What did they do? There are so many. I mean, these airlines are a lot of complaints around that. Anyway, so we are in a correction of air miles restrictions. Well, so right now we are in a correction territory already. So should we fear correction? Could this correction go into bear market? Could it become a full-fledged bear market, which is like 20% down? So look at some numbers. Correction like these are uncomfortable, but these are pretty common. Right? It is difficult while we are going through it, but 5 years down the line, we'll just forget about it, that this thing ever happened. Right? Since 1971, there have been 18 corrections that did not progress into bear market. But it had a decline of almost 14.5% from peak to bottom. So far, the decline is 10%. Right? On an average, the decline has been 14%. So there's still maybe more to go. But the beauty is the market pullbacks that we see after these corrections, they provide great results, right? Stock rising 17% 6 months after and 23% a year later. And that is why it's always said, the best is to stay invested in market. Don't try to time the market. If we see market going further down, you pull out of the market, waiting for the correction to end, and then you enter when the market start going up. It'll be a blink of eye before the market is up 10%, 15%. And so there is a hope. I don't know whether we'll get into bear market or not, whether we enter into recession or not. This particular, if we get into recession, this has been the most awaited recession, at least that I have been aware of. We've been waiting for recession for almost now 10 months. And the recession that has not arrived. So we'll see. Another interesting chart, S&P returns during and after corrections. So this is the list of those 17 corrections, and how much has S&P returned after 6 months. So wow, 40 in 1974. So November, December, market fell down 13.6%, and then it came back and returned 40% in next 6 months. Okay. So this chart shows for itself. So what's next? All right, so volatility might stay elevated for longer. I'm looking at VIX, and it is good to see VIX back to 20 level, right? More than 2021. Not gonna buy any more VIX call spread right now. I mean, I had a VIX call spread just from a hedging perspective, but I think that was expiration October 18th, I guess. So I had a call spread. I sold a little bit early. That's fine. I don't regret that, but I still have to wait to take additional positions in VIX if it goes down. But until then, a higher VIX means better premium. So it's been since May that now we are coming back to some decent amount of VIX to sell some more premium. So stay longer, but because Fed wants to ensure the inflation to return to the target, policy may stay a little restrictive, and market recovery may not be as swift. But if we continue to make progress on inflation, that means we are seeing inflation coming down. Every reading, it is becoming better than the previous one. Still far away from 2%, but it is becoming better. So we may have moved further away from the worst case scenario. Who knows? Right? Mike Wilson, he has given up his bearish target. He has now accepted that 3,800. No, he was probably looking at what, 3,200. Probably not going to happen. Maybe we are away from worst case scenario. S&P 500 has spent 450 days without making a new high. This is the longest since the global financial crisis. Oops. So, and it is about 14% away from its January 2022 peak. So if you go back to the history, it's the first time that it has happened that S&P hasn't made a new high in more than 455 days. So that's does give me some hope that hey, we may not be, we are in correction, but probably nothing to fear a lot from this correction. So not going to make any drastic decisions or based on what has happened in last 3 months. I know 3 months have been challenging. But see, we got a Christmas coming up. We got a holidays coming up. We might get some holiday cheer. We might get Santa Claus rally. Let's hope for the best. Until then, market will do what it does and will continue to reduce the cost basis. That's all we can do. And maybe if you have some money on the side, then we should love these market corrections. I mean, I'll be happy to pick up some of the stocks which probably are now nearing my short put strikes. Why not? If this is at sale, I'll pick some of those up. All right. So what did buy or sell this week? Nothing. Of course, a lot of premium selling happened, but from a stock perspective, nothing. I guess Google is probably, it's trading below my short put strikes, but it's a November expiration. I'm maybe able to pick some Google if it stays there. Amazon corrected after earnings, so close option trade, didn't pick up the shares, put a new one for a December. What else I want to do? Microsoft, that got closed at profit. Maybe Nvidia is currently, I think Nvidia is trading near the short put strike, so we'll see. That's on the macro side. Anything else that caught your eye? I saw some news around Google and Amazon getting AI phobia, being left behind. And now Google is also investing in Anthropic AI company. Amazon has already invested in that company. They're trying to catch up with Microsoft. What else? Anything else that you heard? Steve say, what if the Fed raised the rate another 25 basis points November or December? Then the market will see there'll be some turbulence in market. Right now, market is not at all pricing in any Fed rate increase. And nowadays this Fed governors, they talk a lot in conferences, and we haven't heard or seen any one of those giving any hint around any increase, right? And now the inflation number is also coming down. I don't think Fed will increase, but I don't know. But if it does, looking at the positive side, we might see some more discount in the market. Sri P asks, can you explain how your VIX spreads is a hedge? So when I say VIX spread, basically it's a call spread. So if the market goes down, if there is a fear in the market, market goes down, and then the VIX will go higher. In that case, your call spread will increase in value, while the rest of the portfolio, because the market has gone down, rest of the portfolio goes down in value, your VIX call spreads increase in value. That's why it's a hedge against your long-term holding. And there are various ways to hedge your portfolio. When the VIX was around 12, or my at least on this year, my target is if the VIX is below 14, 15, that's the time when I start to buy some, 2 months, 3 months out, some call spread on VIX, just from a hedge perspective. So,
Vivek,
yeah.
If you have 100,000 of a portfolio, how many VIX call spread would you buy to cover those hedging, what you talk about hedging? I have not been able to figure out that.
Yeah. So I don't use, VIX as the only hedging mechanism, but it is a mechanism. In 2019, 2020, I was very doing a lot more, using VIX lot more for hedging, and that worked out during that March 2020 crash. It gave me a lot of cushion because that time the VIX was at a very low value, right? Over the last 2 years, VIX has been elevated, so I haven't been able to use it except, a little bit of this year when it fell down below 15. Now, coming to your point of, let's say if I have 100,000 portfolio, and how do you hedge it? First of all, you need to determine how much of that you want to hedge, right? If you want to hedge 100%, then you essentially are looking at no gains, right? Then
let's say 20%.
Yeah, so then you could pick up in terms of, if your 20% means it's your 20,000, right? 20,000, what do you want to hedge? Then you can pick up your VIX or a combination of, I use a combination of naked calls or the call spreads on indices plus VIX call spreads for my hedging. At the end of the day, I always look at the overall portfolio delta and see, is this delta I'm comfortable with or not? Right? Now that negative delta could come from the call spreads on. Right now I have a call spread on NDX. I have a short call on XSP. I have a short calls on QQQ. I have a short calls on XLK, because all these are tech, and I have some tech companies in my portfolio. I had VIX call spread. I don't have it anymore. And then I look at what's my overall portfolio delta. Is it good enough? Fine. If not, maybe I'll do some another negative delta trades. I hope it makes sense, but I don't use only VIX.
Yeah, I noticed that the VIX is not very good in hedging your portfolio altogether.
See, right now I have, let's say, XSP. I have 3rd November. I have 10th November NDX. This, I have now only 10th November left. This particular week, from an options perspective, was a real good week because all those hedging trades were closed in profit, right? And then I don't think I have any SPX. So yeah, so these are like XLK. I have a few on XLK, and then against individual stocks, I'll hold covered calls against that. So at the end of the day, I look at my overall portfolio and then see, do I need to reduce these deltas further or not? Okay, can you show us how? Okay, let me see.
Thank you, Vivek.
Right, yeah. Can you explain how VIX spreads? So that we talked about. What do you think about GLD? GLD has been on the tear lately. And, haven't done much for the whole year, almost for the whole year. It started this year at what, 170, right? And till about the first week of October, it was close to 170. Right? But in last 2.5 weeks, we have seen a huge up move in GLD. I think this is also coming from some short covering. on gold. So to me, it looks to be a very extended rally for now. I had a covered call on this, which will be called away. I'll be happy to have it called away. I don't have any issues, but I don't see. I mean, the only reason why GLD or the gold is going higher would be the geopolitical conflict. Other than that I don't see any other reason why GLD would be so higher. So probably has to do with some short covering that's happening on GLD, and that it might cool down. But overall, I think it's a hedge against governments falling. Now we got another the budget ceiling discussion coming. Will be coming up, and now we have a new speaker in the House, which is far to the far right. What I heard is that's probably the rightmost speaker of the House that we ever had. So the discussions is not going to be, there may be a real threat of a government shutdown. So short term, it looks extended. If again, I don't know about your condition, Rajesh, but I'll not be initiating a new position at this point of a time.
Vivek, no, I don't have any position right now.
Yeah.
I'm just exploring the idea.
Yeah. I mean, if you want to have a goal, I have a goal. Goal is one of my top 10 positions. If you want to I have precious metals, gold and silver, both in my portfolio. So at this point of time, I'm not looking to add new. I'll be happy to have my shares called away at this. And if it goes further high, yeah, I'll still have some more, which is I'll still will hold in my portfolio. But I think this is coming a little more from a short covering. Okay, can you show us the trade to try? It will be a call spread for VIX. This is like just a simple trade. Any other call spread if you want to do. Nothing special. But right now the VIX is already at 21. I don't want to do the 21 call spread. But if it were anything below 14 or 15, I'll generally go maybe a couple of months out. Let's say in this case, we'll go to January, and then risk reward, generally I look at it 1:5. That means I may pay $1 to make $5, or if I look at 25 to 30, wrong with 25, you buy 25 call, sell 30 call. It's a 76. Yeah, so that's a decent one. Probably I'll do 5-10 contracts, depending on how much of the negative deltas that I need. I don't have any right now. And majority of the time, you'll probably end up losing money in this if the market is bullish. And that's what I think initial part of the year, all the VIX spreads were, you lost money in whatever you spent in buying these call spreads because the market was ripping higher. But that's okay because the rest of the portfolio goes higher. It's a hedge trade, and I'm happy to lose money on this hedge insurance. But sometimes, like it helped during the COVID one, because those VIX call spreads had, that time I used to do a little differently, and those had returned like 10x kind of stuff. Didn't help the rest of the, it helped the rest of the portfolio in reducing the overall impact. You can't help the market falls down 35%. Yeah, it will give you a little bit cushion, but that's what the VIX call spread will be. Can you share how you track your option trade? Do you have a sheet? I have a Google sheet. I am preparing to wait for the next week. I think I'll be ready by the next week to to share it with others, to have it, available for others. I know someone else had also asked for similar stuff. So maybe next week I'll share how I track it. Okay, I'm still working on it. All right, any more questions? Cool. So let's continue on from our previous week session. This is the last one, is in our investing journey discussion. And then finally, we'll look at some of the earnings. All right, so let's bring up that same deck. Okay, quick recap. When we started looking at pre-investing, right? Make sure the rest of the house the foundation is set before you even jump into stock market or jump into investing. You make sure the rest of the foundation is set. So that was a pre-investing checklist. How to go about, this is all around understanding yourself as an investor. Very important to understand, know thyself is way more important than trying to know some stocks. Trying to understand, we spend a lot of time in understanding particular industry, understanding a particular company, understanding a stock. We spend very little time to understand ourselves, which I now over the years I believe is way more important than to understand a stock. So we went through that. We also looked at portfolio construction. If you are a passive investor, right? How to do portfolio construction using ETFs. Different kinds of ETFs. And then we looked at dating a stock. Means if you want to be little active, you don't want to be, first of all, there is no harm in being a passive investor. But if you want to be active investor because you love this game and you want to become better at it, and then you want to beat the market, which is not easy. You can't beat the market if you're only passive and just buying indices. If you want to be active, then how do you find a good stock? Then we went through the dating period. What are the characteristics we could look at? We went through the whole checklist last week. So today I want to talk about, once you have looked at various candidates, you have dated all of them. Now you want to look at, which ones, how you should start thinking about forming long-term relationships with them, right? So fortunately, polygamy is allowed in stock market. I'm not a fan of having more than one relationships in marriage, but I'll be happy to have 20 and 30 relationship with different stocks, right? So today I want to talk about constructing a portfolio if you're an active investor. And then finally, what you could do if you stay married with the stock during marriage, how you should make sure that your marriage with the stock is successful. Then finally, if it is a time to divorce, what's the divorce process that we could go at? What are the various reasons that we should look at and say, you know what, I want to divorce the stock. Okay, so these are the 3 remaining topics we'll cover. Steve, so you can beat the market passive investing. This is what option is for. Yeah, then once you get in an option, it's no more passive. You are now becoming actively passive. All right, so let's go and look at portfolio construction. Okay. All right, and everyone have a different way to construct a portfolio, right? This is what my way of looking at my portfolio. This is how I have constructed my portfolio. So overall, I divide my portfolio into 3 major categories. What is the core part of a portfolio? And these numbers would change, depending on my mood, or looking at if I figure out something new parameter that I want to look at or evaluate a company on, the numbers could change, but you get an idea, right? I want my core portfolio to be companies with some good fundamentals right? They were big businesses, have seen a demand. They are a decent market size companies with a good gross margin, return on invested capital good without consuming too much of a leverage, right? So these are the companies which I want to make as a core part of my portfolio, right? And around more than 50, let's say 50-60% of my portfolio will be centered around this company, these core companies, which are good companies, fundamentally strong companies, good return on invested capital. Other ones I'll call as a growth portfolio, right? Now, these are the ones which will give me a little more sugar rush, exciting companies, probably may not make money, but may have a good, probably will start making money 5 years down the line, 10 years down the line, right? The new tech companies, they all fall into the growth portfolio. So things that I look into this growth portfolio is revenue growth, right? Because many of these companies will not be profitable. Right? They will be investing every cent that they earn, every penny that they earn back into the business. So things I look at is, hey, you need to have a high revenue growth. If you're not making money, at least you're growing the revenue at a really huge pace. Then third portion would be the rocket ships, right? To the moon. These are the ones, if they work out, these are the kind of a lottery ticket. If it works out, you'll take it to the moon. These will the companies who are addressing they have a huge addressable market. Right? They are the new players or entering into a new geography, right? Or it may be a very new technology that no other player exists. It could be a niche market with zero competition, something like a biotech, right? You have a new patent. These are generally very high risk and high reward companies. Right? These are like a lottery tickets, and there is a very possibility that this could go down to zero, right? I don't expect my, let's say, core portfolio companies to go down to zero. Over the, let's say, 2022, and ever since the interest rates started to hike, these rocket ships, etc., they are the companies which generally have very less revenue or almost no revenue. So they are always dependent on raising money from external sources, either through a debt or through issuing more and more stock, right? So they will continue to dilute you. But it's a lottery ticket, right? And if it works out, great. If it doesn't work out, it won't hurt much. Now, the question as an investor that you need to be aware of, and you need to ask if you are discussing portfolio with someone else, is what percent of their portfolio does that company constitute? Now, the worst thing that you could do, you ask me about a startup, I'm like, yeah, I'm very bullish about this particular company. It's got a huge TAM. They have a patent. There's no competition. They're trying something new. It's in a rocket ship, and you hear this thing, and you go back and you buy and make that as a 10% of your portfolio, and that doesn't work out. That's the worst thing you can do to your portfolio. For me, these companies, any individual company probably is less than 0.5%. Overall, the totality of these rocket ships will be less than 10% of my overall portfolio. So if all of them goes to zero, I lost 10%, not more than that. So it is essential, very, very important. And that is why I refrain from giving, if someone asks me, do you think the stock is good? I can only talk about if the stock is good for me or not. I have no idea if it is good for you, because I don't know what else you hold in your portfolio. I have no idea what your portfolio size is. So the company is falling in this, good for me, because I'm going to control my position size accordingly. So this is how I at least construct my portfolio, looking at core part, growth part, and then something that could take us to the moon. All right, there are different ways. This is something which I want to share before we jump into the other stuff, right? Other thing, now we looked at the how do you evaluate various stocks, etc., right? Now, what kind of stock should I pick in? Few things I look at when I'm looking at my portfolio is that diversification. Right? Overall diversification means first you look at, from a, this is more of a wealth management kind of a discussion. Hey, how much do you want to have in your real estate, stock, bond, cash, precious metals, commodities? I am not a commodities guy, so I have almost zero exposure to commodities. I do hold precious metals, but that too is a part of my like GLD, SLV. Yeah, stocks, bonds, cash, real estate is a physical real estate. So that's one kind of a diversification I look at. Other kind of a diversification is geographical diversification, right? Do you have 100% exposure only to one geographical area? Let's say US. Or if you want to go and get some diversification outside of US, there are ways to do it. And the beauty is, at least on the US stock market, you have instruments that will allow you to do and get exposure to, to almost any part of the world. So US SPY, if you want to go ex-US, you got VX-US. If you want to go to emerging markets, there is EEM. If you want to get exposure to specific countries, you have a country-specific ETFs. Now, all I'm talking about is, hey, this is, if US is not doing good, maybe there are some other markets that are doing better than US. Do you want to look at that diversification? Third is sectoral diversification. I think when we generally talk about diversification, the folks only by default, it means sectoral diversification, right? Hey, when you're holding your portfolio, make sure you have some tech, some utilities, some consumer discretionary, energy, financials. There are 12 major sectors in S&P, 11 major sectors in S&P 500. Make sure you're not having all tech. Some mistakes I've seen investors doing it. I'm diversified. Okay, what else? What do you hold in a portfolio? I hold 20 25 stocks. And then when you talk about those stocks, you realize that out of 25, 15 are in tech. I'm holding NVIDIA, Google, Meta, Microsoft, Amazon, Zscaler, CrowdStrike, and they realize that that's not really diversified. And you have 25 tickers, but essentially, more than half of your portfolio is in tech. As long as you're okay with it, that's fine. Right? But let's understand that's not diversification. So you have to make sure you can hold as many uncorrelated tickers in your portfolio. Right? Look at the correlation and then see, hey, if both the stocks are moving at 90% correlation, that's really not diversification. You should try to get as many uncorrelated tickers as you can. And that's where you have like TLTs, GLDs, these metals, because some of these things that don't move they have a little less correlation with the overall stock market. So that's one way to look at diversification. Another one is I wanted to introduce is a timescale diversification. Right? Do you have what kind of the stocks that you're holding? Do they match with your the timeline of when you need the money? Right? If you're holding a lot of growth stocks, or if you're holding a lot of bonds, but all of them are maturing, let's say 15 years down the line, then your money is stuck for that 15 year. So essentially looking at when do you need money, the small, medium, or long term, and finding the companies that will give you those kind of cash flows, or be able to have you'll be able to withdraw that during the time frame when you need it. And finally, if you are on the option side, there are a few additional things that you look at while dealing with options is your diversification in terms of expiration period, expiration dates, diversification in terms of strategy. Am I all on short puts, or am I all, iron counters, or am I doing all as a, do you have a lot more of iron flies? You'll mix and match a different strategy. And of course, we talked about delta management. So these all, this is why I say, if you are active, then you should look at, and see how you could diversify your portfolio. It will be, at the end of the day, the whole objective of the diversification is to have less volatility in the portfolio. That helps us to sleep well, helps us to stay invested. So that's on a portfolio construction. Any question? Any other ways you guys diversify your portfolio? Something that I've not covered here. Any other way of looking at diversification? Any thoughts? Okay. All right. So now you dated many stocks, look at diversification. Now you bought those stocks in your portfolio. Now you're married to those stocks. So let's talk about the next one. Congratulations, right? Now you're married to stocks, you pick up 10, 15, whatever number of stocks. That will give you enough diversification. And now your hope is what we see in the right side, right? That the stocks will go like this. Once I buy the stock, I think, oh my, it's going to go to the moon. My life will be happier. Now I am this stock and I will stay together forever. Right? I wish when I buy a stock, my objective is I'll probably never sell it. Right? Minimum is 5 to 10 years I want to hold, but essentially the objective is I probably will stay with it forever. But that's not how neither the marriage goes nor the stock goes. We go through these old emotional cycles of investing. You have seen this chart a lot many times. I think this 2021, 2022, 2023, we have gone through this whole scenario, right? From optimism to euphoria in 2021. Then 2022, we are here, panic, despondency, markets are all down. No one would want to talk about stocks anymore. No discussion of stocks. It was off the dining table. It was off topic in any parties, right? And but this is how stuff goes around. It's never goes straight up. Like though we would want to think that it should go straight up, but it never goes straight up. So what do? There will be periods of euphoria and despondency. Doesn't matter how great the company could be. Right? Even the ones which are forming core part of your portfolio, you will go through these periods. Right? And the more you are ready for this, the better it is. And that is why I said the investing has got a lot more to do with understanding yourself and building a mentality and a strong stomach than building a great IQ and finding a great stock. So during these periods, how do we stay married? Let's go back to the science. The pain of loss is 4 times the joy of gain. Right? We want to avoid the pain. So idea simple is reduce the pain. So when you're buying a stock, make sure you are working towards reducing the pain. That will help you to stay longer and longer with the stock, because if the stock goes down, or if there is a fear that the stock may correct, and because the pain of loss is a way bigger driver than the joy of gain, you end up selling the stock. So how do we make sure that we can reduce the pain of staying with a stock? So essentially, pain in the stock is nothing but the cost of labor, the cost of your dollar that you invested in the stock, right? If you bought a stock and you invested $1,000 in a stock, max you could reduce is max you could lose is $1,000, right? Unless you're doing some stupid stuff around leverage and all that stuff. We are not getting into those things. We're only talking about you bought the stocks, right? Stocks does not go negative. So all you can lose is $1,000, and your overall pain will be $1,000 pain. So how do you reduce the pain is what I want to focus. So pain is equal to your cost of owning the shares, which is also your total risk. $1,000 invested, $1,000 is the risk. You can't lose more than 1,000. So how do you stay invested in this relationship? Just reduce the cost of owning your shares. Plain and simple. If you get some stocks for free, it's much easier to go through these difficult times, right? Because, hey, I've not invested anything in it. So every gain will be positive for me. So I'm ready to continue to hold those stocks. So that's what at least my philosophy is. You get the good stocks, then just relentlessly focus on reducing the cost basis. Be relentless. Right? Now there are some ways to do it. You can pick up whatever ways work for you. One way is if the stocks are going down, you time the market and you buy more stock. Right? Oh, I bought Google at I bought Tesla at $400. Okay, and now I bought 100 shares. That makes 40,000. Now the Tesla is at 200. I buy 100 shares more, so my overall cost per share has now become $300. Right? From $400 per share, I've reduced the average cost to $300. But the problem with this is it will need additional capital. Now I need to find another $20,000 to buy 100 shares of Tesla. So number two, it needs me to have a crystal ball. I don't know if it's going to stop at 200. If it goes down to 100, am I going to buy more 100? It needs unlimited capital. I don't have unlimited capital. Right? But this is a way to reduce your cost basis, and many investors go by this way. There is nothing wrong. As long as you understand what's your overall position sizes on that stock and you have a capital to do it. But every additional capital invested does increase though it reduce the cost basis per share, but you're adding more capital, you're bringing in overall portfolio, you're adding more risk. Other way is to get a dividend income. Right? Invest in the stocks that will pay you dividend. And some people say dividend is not free, but market does consider it because, hey, because dividend is coming from companies, so eventually it will impact your share price. But parring that argument, you paid $400 for Tesla. Tesla pays you, let's say, $20 per year as a dividend. So your cost of owning the shares of Tesla continues to go down by $20. But then you have to find the companies that pay dividend. Majority of the growth companies won't pay dividend. And then if you are looking for some tech companies, they don't pay any dividend. Many of the good companies, they don't pay dividend. They just reinvest the capital. Like Berkshire Hathaway doesn't pay dividend. And then you're dependent on the capital allocation decision from the CEO or CFO. But these are the ways in which you could reduce your cost of owning per share. The third is selling options. So my preferred way is this third one. And now you could sell. There are different ways of continuously generating income by selling options. Covered calls. It means you need to have, once you have 100 shares, you could start selling call against it. So when you sell a call against the shares that you own, you get paid a premium. And on an average, you could actually have 10 to 15%. Again, it depended on stock to stock and also the volatility in the market, the VIX levels in the market. But over years, I realized that around 10, it's 10%, overall premium that you could gather in a year, 8 to 10% is not that difficult. So while we wait for the stocks to do what it does, you can always sell covered calls and try to get 8 to 10% reduction in your cost basis. Now there are other ways. How do you manage it if stock continue to rip higher? Someone who has sold a covered call, let's say in February or March of this year, maybe sitting and repenting and say, oh gosh, I lost the opportunity. These are the other details that we could go into some other sessions on how to manage and all that stuff, what deltas to look at. But these are some of the ways to reduce the cost basis. Sell strangles, right, which will allow you to pick up a stock if the stocks fall down and you really want to buy it at a lower price, you can sell strangle, which kind of gives on both sides, right? If it goes higher, you will be able to sell it at a higher price. If it falls lower, you will be able to buy it at a lower price. But if it stays between the two strike prices, you reduce your cost basis. Right? Nothing happens. Both expires worthless. Whatever money you got, it stays with you. That reduces the cost basis. Selling covered call spread. Right? This is essentially for those big growth stocks. You don't know the stocks could, like things like Nvidia, right? Nvidia could become, was up 200%. You don't want to be lugged out of further gains. Instead of selling just a call, you could sell a call spread, right? Or there could be any other combinations of any options. At the end of the day, the target is how can I get more and more premium? How can I collect more premium? And that reduces my cost basis. And for me, it has worked over the years. 1-2 months, you might think, oh, come on, what am I doing? I just get like a percent, right, or a 0.5% is not worthwhile. But over the years, these numbers do add up. And I have stocks that are almost, I think 85% of the stocks that I own have benefited from this. And there are some stocks wherein the cost basis is now down to 40%, 50%. There are a few where the cost basis is now negative, but it has taken a few years. The other one which I like, especially in when the markets are ripping higher, is a combination of a put spread, short put spread, and the covered call, right? Some call it as jade lizard, or I don't know, which are different definitions. But that's one of my go-to strategy, right? Let's say I own Meta, I'll sell a put spread and a call against Meta. And if it falls down, I'll pick up some stocks at a lower price. But if the bottom falls out of under Meta, because it's already up 130-50%, I want to make sure I'm protected. So instead of doing a strangle, I'd rather do a put spread. And so there are combinations that you can use. Now it depends on what you hold in your portfolio, what's your outlook about the stock is, how have you seen, is the stock too volatile, is the stock relatively stable, is the earnings coming up, and all that stuff. So this is like really active management. And like Steve was saying, yeah, you could, using option, you could, even on indexes, you could beat the market. Yeah, you could, but then you have to be active. Okay, so that's like there are three, we looked at three stuff: double down, but is not need more capital investment; dividend, but that not all stocks pay dividend. Third is options. Generally, all the stocks will have options. I try to stay with the stocks that have options. There are some stocks that don't have options. Then there is nothing much we can do about that. Yeah. All right. Any questions on this one? So first is how to reduce the pain is relentlessly focus on reducing the cost basis. Okay, let's continue. Other thing what you should do is stay up to date with your partner, right? First thing is you must know the name of the CEO of any company that you own. And if you don't, please go and try to find out the name of the CEO. Next time, before you invest, write down the name of who the CEO is of that company. Now, my intent in focusing on CEO name is, my intent is not that you have to remember the name of the CEO. The intent is that in order to find out the name of CEO, you'll go and Google that company. You might see some news. You'll get a little more educated about the company, right? But have some bare minimum stuff that you said you do want to know the names, or these are the things that you would want to know about these individual companies. Otherwise, you have no business in being in an individual company. Stay with ETFs. So know who the CEO is, possibly what the market cap is, follow their earnings, see what's happening in their earnings, good, bad, ugly. If you can't follow all quarterly, at least maybe follow at a 6 monthly cycle. After 6 months, go and look at what has happened. Has your thesis changed? You invested for something. Has company done anything different? Or you can only go back and do it if you have a journal to keep track. So when you invest, write it down in your journal on investment is why did I invest? Okay. What will cause me to sell it? So because that will help you if market has a turbulence, go back to look at journal and say, why did I invest in it? And what did I say? When will I sell it? If that nothing has happened in the market that you wrote down on when you'll sell it, then there is no need. This is just to control the emotions that we go through when the markets are topsy-turvy. The journaling really helps. So that's all. Stay up to date. Check your thesis after every quarterly earnings and reduce your cost basis. That's it. Simple. Any questions on these ones? What else you do when you're holding your stock? Okay, Jay had to say what websites people are using to see correlation levels. Your broker can provide the service. Okay, stock charts. I think I had some website in which you can put in some tickers and it will give you some correlations. Yeah, if you could Google it, you should be able to find that. Otherwise, maybe after this, I'll see if I can pull up that website. All right, let's move on. Now let's talk about there are times when the stock doesn't perform, or rather, let me put it, the business doesn't perform, or there are other reasons why you should be perfectly okay to divorce the stock, right? One is that the original thesis that you had when you invested in the stock is busted. Oh, I thought this is going to be an AI play. And then you realize that they don't have any AI advantage in their business. They just turned out to be a implementation consulting company. It only talked about AI, but they don't have any tech of AI. They just implement. So there is no moat around that company. My thesis got busted. I was wrong in understanding that company. So I misread the business, or I misjudged the moat. Or we talk about moat on, let's say, I think it was the last week's meeting. We looked at ASML. ASML a moat in terms of their EUV lithography machines. Now, if someone else develops the same lithography machine that EUV that ASML has, well, that's clearly is gonna breach that moat. Investment thesis has changed. Or the management is struggling to execute. The business was fine, moat was fine, there are patents, but the management is not able to execute. And you'll only get to know these if you follow through the earnings and see how the company is executing or not. Right? Maybe there are major legal ruling goes against the company. The brand is deteriorating. So there are various ways from a thesis perspective that the thesis hasn't worked out. The business is diversifying. Diversification, and I do have a stock which went through this process of they just bought out of a way and acquired another company, and right now they are just struggling. So I'm perfectly okay to let the stock go away, but I haven't spent at least 5 years with the stock, so I'm still hoping that they'll be able to recover. In last 2 quarterly earnings, I've seen them moving in the right direction. But there are companies who will, when you buy them, will look great, but they'll do some of these stuff which will could bust your original thesis. Right? The company is being disrupted by another competitor. What are the other ones? Everything worked out for me. Stock is great, but now they already achieved. They are already on the top, and they don't have any second act. Right? And this is one of the most difficult decisions, is to quit is when you're actually right. It becomes easier to quit when you're proven wrong, saying, oh gosh, I made a mistake. Let's own up to it. But it's very difficult to quit when you're right and at the top. It means the company has already achieved what you thought it would. It has reached the mature cycle in its business, but there is no other act. They haven't come up with the next big thing, like Apple. The next stuff is. Right? And these are the difficult decisions, and these are the stocks which people and the investors will own for a long time, and they fall in love with these, that it's very difficult to sell these. We had IBMs and the Dells of the world, didn't see much growth after that. There was no second act. IBM is still trying to do the second act of moving into cloud, but who cares? IBM cloud, nothing. So great companies will reinvent themselves, find a new sources of organic growth. Right? Good companies will find a second act. Apple, iPhones were the one that catapulted Apple to the most valued company on face of earth. But then you can only sell so many iPhones. So Apple found a new source of revenue, which was services. And before 2019, they didn't even show you the separate numbers in services. That was a business that they started building on the side. And now it has become almost $80 billion worth of business. Amazon was an e-commerce company. And then the AWS was their, someone say AWS was their second act. I consider probably AWS as their first act, and advertising could be a second act. And we're going to look at advertising revenue of Amazon. Google, YouTube is their second act. Right? YouTube is a big business, like $30 billion plus business. Microsoft had almost lost their revenue. Oh, sorry, lost their relevance. Almost, I would say, it was strong in enterprise, but for consumer side, they had almost lost their revenue, and then they came up with their cloud offering. Oracle is it's only last 2 years that Oracle is coming into discussions for investors, right? It had its prime days, it had its golden days. Those are all past, but now it's trying to create a second act through their Oracle cloud. SAP is going through that same process. Splunk is going through the same process. Whether they'll be successful or not, who knows? But the companies will have to reinvent. You cannot, when I say you, means the company, you cannot rest on the laurels of one product that you've been selling for years. You have to figure out a ways to continuously grow your revenue. And in this case, even if your thesis was right and the company is only in the mature phase, that may be a reason that you may want to go and look at some other company and divorce the stock. But this is a very difficult decision to divorce it. Third is bad bookkeeping, right? Financial irregularities, restatement of financial statements, lawsuits regarding accounting practices. Now, this is the one in which, I would say, hey, if I can't believe the numbers that you're putting, then I just don't want to own you. And no questions asked. Now, fourth one is nothing to do with the company. It could be a great company, but it's already become a too big portion of my portfolio. So now you have to identify what's the right percent for you. I can't tell you. And that is why during, initially I was saying, if you ask anyone what stock is good for you, it may be good for me, but it may not be good for you. Because if you already own it, there is no reason for you to now own more because, hey, I heard Vivek talking about it. And so it's a great company. I'm going to load up on it. I don't have a crystal ball, neither do you. So if it could be a good company, if it has become too big position in your portfolio, and you will identify it as too big because if you're thinking about it while sleeping, if the stock goes down 10%, 25%, then it is too big for your portfolio. Any stock that you own, that I own in my portfolio, be ready for 30 to 50% drop. If you're on the growth ones, be ready for even bigger drops from their all-time highs. So far my target is any individual stock. For me personally, not more than 10 to 15% of portfolio. I might have some ETF that, let's say SPY, could be more than 15%. But individual stock, I would want to limit exposure to any individual stock to be more than 10 to 15%. Now it also depends, and this let me put it that way. One factor that also determines this is what stage of wealth building are you on. If you're just starting your investment and you're in an accumulation phase, then this may not apply to you. So depending on which phase are you on, then you'll have to take the risk. Let's say if you have only $1,000, you can't spread $1,000 or $5,000 over 20 companies. Hell, it doesn't work for you. So you'll have to buy maybe 2 companies, invest $500 on each. If you're in an accumulation phase, probably you might be okay to have some good companies as a larger part of your portfolio. If you are in a preservation phase, conservation phase, then probably at least I will tone down how much of each company, the position sizing in my portfolio. Again, it is different for everyone. My test is if it is causing you to lose your sleep, it is too big. I don't care how great the company is. I don't care what the market says, but if it's causing you to lose your sleep, it is too big. Go and reduce your risk in the portfolio. Right. Other reasons to divorce, and this is the great reason to divorce, it's a time to enjoy the fruits of labor. Right. Hey, I invested in dumb Tesla, go for Lucid. I invested in Lucid because I wanted to buy a fancy car that I have been eyeing on. And now Lucid has delivered. I'll sell my Lucid shares and buy that fancy car. Right? Perfectly legitimate reason to divorce the stock or to sell the stock. Third one, and the next reason is egregious valuation compared to the opportunities that lie ahead. And I did not have this in my list until 2022, until I'd gone through 2021. Okay? Because the valuations in 2021 of some of the companies that I held at that time became egregious. And I was at a mistake of not selling them at those egregious valuations. Right? Good companies will be overvalued, and I'm okay to hold them even at that overvaluation. They will be valued higher than the average player in the market because you may not find you'll have to pay up. Let's say you have to pay up for a quality, right? But some cases, and 2021 was that a case when those valuations became egregiously high. So I learned my lessons and saying, okay, now I need to update it, saying, give a heed to valuation, look at a valuation and see where it is on the spectrum with respect to the opportunities that lie ahead. Is it overvalued or it is egregiously valued? And now I will sell the stock if I find or if I think it is egregiously valued as compared to the opportunities that lie or as compared to the execution that I've seen from this company. Next reason, everything is fine, but I don't have time to follow the company. Those who have been coming here for now 3.5 years would know that 2022, I mentioned that will be a time when I'm going to trim my portfolio. So I already trimmed more than, almost 40% because I had no time to follow all the companies that I hold in my portfolio. 2021 was the heydays, anything you pick up was going up. So I also had accumulated a lot of stocks that I actually didn't have a time to follow. I didn't know who the CEO was. I did not follow those earnings. So then I realized I need to clean up my act and then sell the company if I don't have a time. Or in some cases, maybe you're not interested in following that company anymore. So that may be a perfect reason to sell the stock. Now we're coming to a little more very tactical is tax loss harvesting. And this is the time when as an investor, you should look at your portfolio. I'm looking at my portfolio and seeing, is there an opportunity for me to do some tax loss harvesting? It could be a very, like I said, calculated short-term tactical move. I'm going to sell my stock. And now, at least this year, the markets are up. 2022, you had a great opportunity to do some tax loss harvesting and, basically sell those shares and take some, reduce your taxable, overall taxable gains. But this is a reason, a good reason to divorce. Another one is, if you're trading and you're dealing in options, your covered call gets called away. Right? Hey, some news came in and the stock jumped higher, and I know that this is this is a temporary jump. There is nothing fundamental change in the company. So I'll be okay to let it go called away, and then I'll sell the puts later on. I think that's it. In any other reason on when you will sell the stock or let your stocks get called away? Anything else to add? All right, so I think that finishes the overall investing process. So we went through the dating period. We went through the prep period, went through the dating period, went through the marriage period, and finally the divorce period. Shripi, take some profits. I think that gets covered into we want to enjoy the gains, what it was meant for. If you are saying take profits because the stock has gone up and then you'll buy again, that's more like timing the market. I'm not a big fan of timing the market because I don't have a crystal ball. Can you start how you do delta management and hedging decisions? Sure. So again, like I said, I look at I always want to give myself room for error because I want to have that margin of safety with me when on my portfolio. And one way to give that is to reduce your deltas, because if I'm only holding stocks, as you guys know, it's a one-way. It's a one-way to profit is only if the stocks goes higher, right? Now, if the stocks are going lower, how do I reduce the risk? Is what I call as your portfolio hedging, or the managing the overall delta. So if you are looking into your, and I don't know which broker platform, but there are broker platforms that will tell you what's the overall delta of your portfolio is. Thinkorswim shows you, Tastyworks tell you what's the overall delta of your portfolio is. So I have, let's say, some numbers in my mind saying if the market is SPY, so I focus mostly on SPY and take SPY as a representation of my overall kind of a portfolio across different accounts. And then I both on Thinkorswim as well as Tastyworks, I beta weight my portfolio as per SPY, and then I look at how much that shows me how many deltas you have of SPY. Now the question is, how do we reduce those deltas? So we're gonna do a few things that you can do, and that's what we talked about earlier. Is you sell calls against the stocks that you own, but then you need to understand how to do a management of those calls. You could sell calls or call spreads against the indices, and that is my preferred way, is to sell, calls, short calls against, let's say, QQQ, SPY, XSP. Ever since I think it was Jay who introduced me to XSP, I stopped doing SPY. And then call spreads against NDX, SPX, and I haven't done much of RUT. But yeah, NDX, SPX, call spreads, because those are much bigger instruments. And then basically calls, covered calls against individual stocks. That's it. How many beta weighted delta to keep per 100K? Some overall range you try to aim. If you look at Tasty Trade have some numbers. I think I had those numbers, but I don't follow exactly their numbers. My for, let's say, for, again, this is dependent on where the market is. Right now I'm comfortable carrying 1,000 SPY deltas in my portfolio because the market is at what, 4 and 13 or something. I'm comfortable to hold 1,000 positive SPY deltas. If the market is at, let's say it was at around 450, that time I had reduced it down to around 500. I was like half of what I own. I generally don't have negative deltas. Tasty Trade will, their main idea is keep negative deltas because you already have the risk from your short options. But I am generally optimist. So I have the numbers that I've realized works for me. And also depends on, what's the overall size of your portfolio, etc. So there is no one number that I can give you, but something that I figured out, okay, works for me. Based on that, I'll keep those deltas. But the main idea here is you need to find what's the right number for you and keep an eye on it. Right? And that number will be different for every different investor. Okay, so hope makes sense. There is some guideline, and I don't know where that, I think that it's in some other room. There is a guideline from Tasty Trade on per 100, I forgot that. Per 100K, how much of a negative delta, and basically delta and theta ratio. If you need, maybe next meeting, I'll tell you. I had it somewhere. But now I know how much delta I need it, where the market is. So for example, right now I didn't do too many of a delta because last week a lot of my delta hedging trades had closed. So far October has been great for me when it comes to the options, right? Because the market is not doing good. So I was still thinking about it, that should I add more negative delta? Right now I'm close to 1,200 positive SPY deltas, or should I reduce it further? And then I'm looking at it with the chart that will maybe let me get through October, because if this impact in October is happening only because of, let's say, the seasonal tax loss harvesting, then we should see the November and December might be a little positive. In that case, I don't want to reduce delta right away. Right. So then I'll probably wait for another week or two. So these are the decisions that I'll take depending on situation to, and if it was not November and December, after closing a lot of those delta hedge trade, I would have just added a few more. But this Friday, I didn't do it. I'm just waiting for, okay, let me wait for a November 1st week, one week of November. How many positive? Yeah, okay. So you wanted how many positive beta weighted delta one should be comfortable with at a portfolio level, right? I mean, you have to find your comfort zone, and this will also depend on where the overall market is. If SPY is at 480, I will not be comfortable holding 1,500 or 1,000 a portfolio beta weighted delta. All right, maybe we could do a separate session on this one. All right. Let's jump back to quick earnings. And that will be the last part of today's session. Unless there is a few other questions. All right, so let me just bring up the earnings document. We're gonna talk about Microsoft. Let's do, where is, hold on, just give me a moment. Let's start first with Microsoft. Okay. All right, let's do a quick run through of these 4 tech earnings on Microsoft. So this is my investing journey. So Microsoft, if you hear Satya, he probably talked about AI, infusing AI everywhere. We are making the age of AI real for people and businesses everywhere. We are rapidly infusing AI across every layer of the tech stack and every role and business process to drive productivity gains for our customers. So essentially, AI, and I think Microsoft is further ahead of the other 2 tech giants, both Amazon and Google, in terms of their lead in AI, thanks to OpenAI. And now they have a lot of customers that are already trying out their AI solutions. So overall, revenue was up 13% to $56.5 billion. Gross margin is 71%. So that's a sign of a great company, right? Operating income is 48%, up to $26.9 billion, and net income is $22.3 billion. Overall, everything good. So what do I want to look in Microsoft? Essentially, the biggest thing that we want to look in Microsoft is how their cloud is doing. So cloud revenue is $31.8 billion, out of which I think Azure was little. Where was my Azure stuff? The overall cloud revenue is $31.8 billion. And if you look at the way their cloud revenue has grown, it has grown from 25 billion. Every quarter has been growing to 31 billion, but gross margins all constant, which is like doing great. Now, if you look at this chart, cloud run rate in billions of dollars is, run rate means for almost 12 months, right? It's like they're doing it at a run rate of $127 billion. Now, in 2019, like it's not even 5 years, the overall revenue for Microsoft was close to $125 billion, $126 billion. Now, just the cloud portion is doing the same amount of revenue what the whole Microsoft used to do just 5 years ago. Right? So that's what, like, the cloud is their second act. Other thing is the LinkedIn revenue, which is up 8% year over year to $3.8 billion. LinkedIn also had some layoffs this week or the previous week, but so far nothing to worry about in Microsoft. The main focus on cloud. They announced their Copilot. Copilot will be available starting November for their enterprise customers. If you are using a Windows, it will be available. Now they also have AI or Copilot for Windows as an operating system that will be available also if you're using Windows. So that's a quick Microsoft. Unless there are some questions, let me see anything else caught up my eye on Microsoft. Nope. All right, let's quickly move on to the next one, which is the next one, Alphabet. Let's go to Alphabet, Google. Google, okay, Google. All right. What does the Google CEO say? I'm pleased with our financial results and our product momentum this quarter with AI-driven innovation across search, which is Google's main, YouTube, cloud, our Pixel devices, and more. We are continuing to focus on making AI more helpful for everyone. There's exciting progress and a lot more to come. Ruth Porat, the CFO, said the fundamental strength of our business was apparent in Q3 with $77 billion in revenue, up 11% year over year, driven by meaningful growth in search and YouTube and momentum in cloud. We continue to focus on judicious capital allocation to deliver sustainable financial value. So focus on AI, focus on cloud. Those are two big drivers. Revenue, almost 76.6 billion, up 11%. Operating income is 21 billion, 28% operating income margin. That's great. And net income is almost $19.5 billion. So it's a big money. Now, what I want to look at when I'm looking at Google are two things. One is how their YouTube has basically three big businesses. Google Search, this is their bread and butter. YouTube is their other, up and coming business. I would say they didn't used to show YouTube numbers separately 6-7 years ago, but now they're starting showing up separately. Now this itself is close to $30 billion worth of a business, right? We saw some slowdown in YouTube in 2 quarters ago, but now it's back up. So it's back to the growth engine. And third is the Google Cloud, right? Google Cloud is also handsomely up, but market didn't like it because I think they were expecting even further growth from Google Cloud. So Google Cloud grew around 21%, 22%. Whereas the Microsoft Cloud grew 26%. So the concern was, hey, is Google losing the lead? Is Microsoft taking more share of the cloud revenue from Google? And the stock was punished. So stock was down, what, 10%? Oh, where's it? Yeah, so from 100 and close to 140, now it is 120. So after earnings, the day after earnings, it dropped 9.5%. That's the biggest drop in for a long time. I don't see any. Maybe this was, close. Maybe this was the 10% drop. That's the only big red candle I see, which is way back in February. A 1-day drop. So, but I don't know why this is such a big concern right now. So I'm not selling my Google shares. I still hold it. What else did we see from Google? In Jan 2023, announced a reduction in workforce. So they had to take some employee severance charges of 86 million and 2.1 billion for 9 months. So basically in this quarter, there was 86 million came from severance charges. The other thing is their Google net income, which is 19.6 billion. Some of that is also coming from the change in the adjusted life of the equipment, of their server equipment. And Google does this. This is, I think, the second or third time that they've done, is changing the useful life. So that will allow them to depreciate slowly. So that will increase their interest income. Right? Net, I think is still a very strong balance sheet, $119 billion in cash. Right? The current quarter results were good. So Google, from an advertising perspective, Google saw good numbers, but the cloud revenue is what, killed the stock. The cloud didn't grow as much as the market was expecting, so stock was punished. Google is, for me, when I run the Google through the valuation, it seems to be very attractively priced. So currently, what it is, $120 share. So that is like, it means the current valuation assumes that Google is going to grow its cash flow for 6% year over year. So let's look at, let me bring up and see what Google has done in the previous years. And this is the exercise that to do after earning, to see, does it make sense to continue to hold Google? So if I look at free cash flow growth, I mean, looking at how they've performed over each quarter, I think it's easy to get 6% free cash flow growth. So that seems to be very attractively priced. So right now it's only pricing in 6%. And I think Google can do better. So that's why I'll be happy to pick Google at this current price point. Again, not a financial advice. This is not a huge part of my portfolio yet. Yeah, it is part of top 10, but not a big one yet. So I don't mind picking more if it gets assigned to me. Any questions on Google? All right. So while Google said they're looking good on advertising, they saw advertisers returning to, to business. We heard a different one from Facebook. So Meta is coming to Facebook, aka Meta. What I want to look at when I'm looking at Meta is reality labs. How much are they burning in reality labs? Because that's their the new foray into metaverse or AR world. So what market is, we had a good quarter for a community and business. I'm proud that the work done by our teams done to advance AI and mixed reality with the launch of Quest 3, Ray-Ban Meta smart glasses, and our AI studio. Overall revenue is up 23% to $34 billion. Cost and expenses are actually down. So if you recall, Mark Zuckerberg had been harping upon the year of efficiency, and they had done a drastic cuts in the employee strength, have been cutting cost, and now it start to show up in their expenses, right? So while the revenue grew 23%, their expenses were actually down by 7% year over year. Right? And that shows up in the huge, jump in operating margin, which is like double the margin that they had seen in 2022. All this is coming from the focus on efficiency. So they are executing whatever they had told earlier. Net income is $11 billion, up 164%. So they beat the expectations from a revenue, beat the expectations on the EPS. Let's look at some of the business metrics. Family daily active people, 3.14. Wow. It's like, and family monthly active that use Google, Meta's properties, 3.96 billion. Like more than half of the world is actually uses Facebook, or not Facebook, uses Meta properties. That is, it is difficult to get bearish on Meta. There's such a huge user base. What else? Good improvement on ARPU, $8.71 average revenue per user. Other thing that I want to look at is Reality Labs. So Reality Labs continue to lose billions of dollars. At this rate, they're gonna lose, close to 12 to 13 billion dollars. But I guess maybe 5 years down the line it will pay off. They have I think also the guidance. I know how. I didn't get the balance sheet out here. Oh, hold on. Let me just see if we can get the balance sheet. Q3 2023. How much do they have cash? Good cash flow or no balance sheet here. I think they have around $60 billion worth of $60 billion. Yeah, I believe they have around $60 billion cash on their balance sheet. So they have enough cash. Oh yeah. Oh, this is what this is Meta. Okay. Yeah. So they do have around $61 billion cash. So pretty strong balance sheet, I would say. But stock got punished because of the statement that they made was two things. The bigger one was because of the conflict that's going around Middle East, they are seeing some pullback, or they expect some pullback in advertising. And that was the reason why the stock got punished. The other, I don't think that's a big reason, but they did mention that we are expecting higher cost next year. So they're gonna hire a few more people, especially on the AI side, and also will invest more into the infrastructure for building those AI services. So that's on Meta, and I don't think anything else caught my eye. So grew revenue 23%. We have talked about layoffs and cost cutting helped in operating side. Cost guidance for Q4, that was a beat. Yeah, Reality Labs continue to lose money, and a concern on ad demand softening due to Middle East conflict. That's on Meta, and last one is Amazon, and then we'll be done for today. All right, let's get on to Amazon. Okay, Amazon net sales increased 13% to $143 billion. And the operating income is $11.2 billion as compared to $2.5 billion in third quarter. So that's a huge jump from 2.5 to $11.2 billion. Now net income, which is the bottom line, is now $9.9 billion as compared with $2.9 billion in the previous year. So both on the operating income as well as on the net income side, they're seeing they reported a huge jump. Again, now this net income also is coming a little bit of a net income, which I think is $1.2 billion is coming from Rivian Automotive. So even if you take that out, it's still $8.7 billion, which is still, big jump from $2.9 billion. So I would, because this net income is impacted by Rivian, so we should just maybe focus on the operating income, which itself is a big jump from $2.5 billion to $11.2 billion. Again, focus on cost cutting. Free cash flow is improved to an inflow of $21.4 billion, whereas previously it was an outflow of $19.7 billion. So huge jump on the free cash flow also. What else? Let's look at some business updates. So if you go into Amazon's earning results, they brought a huge, too much of an information. I just picked up a few to talk through it. One is a buy with Prime features. So even if you're not selling it on Amazon, you're selling it on, let's say, other properties, it will help merchants to grow their business on their own websites. Or even if they are selling it through Shopify, they'll still be able to have buy with Amazon, in which Amazon will handle all the logistics, etc. They also have expanded Amazon Clinic virtual healthcare marketplace, which is now available across the US to provide care for more than 35 conditions. Launched Prime Video channels and Prime Video store in a few more countries. And lastly is new AI-driven commitments and expansions from AWS customers. Now, a few things that I heard during the earnings call. One is this: the Andy Jassy, CEO, still thinks that AWS, there's still a lot more growth to come on AWS. So right now, the AWS, which is we consider as the growth engine, over the years, the growth is kind of slowing down. I think this quarter it grew only 12%. And the market wanted to know whether the growth rate has bottomed. Should we expect to see future growing at a higher ones? So Amazon did say that they feel that the AWS should continue to grow at a faster pace in the coming quarters and in 2024. That's why the Amazon shares was up like 10%. Because again, if AWS is coming back to a growth engine, that's going to be great. And Andy Jassy says that 90% of the IT spend is happening still on-prem. So there's a lot more growth potential still pending on just on AWS. Okay. Other thing I had, I think I had some more stuff I wanted to share on Amazon. Okay. I didn't format it completely. But other, okay, so let me make sure I can bring that up. So this is what second or third act of Amazon. I want to bring their advertising revenue. If you look at the Amazon's advertising revenue, it is now $12 billion this quarter. So this business, right? I think we started talking about advertising revenue 3 or 4 quarters ago, and say, hey, want to keep a watch on this one. This could be second act for Amazon, wherein they, to have merchants advertise their products on Amazon website, and if you advertise it, you will be featured higher on the rank. So it's kind of merchants have no other choice, I would say, than to advertise it. So now advertising revenue is like $12 billion, which is almost half of AWS. Right. So we should keep an eye on that one. That business has been growing at 25% year over year and is already close to $48 billion annual run rate. So Cass, that's it. So overall, market want to know if the AWS growth has bottomed. Yeah, Amazon gave a good news around that. 90%. Okay, so we are all talked about it. AI phase is too early. Even though he talked a lot more about AI, if you go and look into the earnings transcript, or sorry, maybe the earnings release, they talked about a Bedrock, which is their offering for AI. They talked about I forgot that code, which is more. Let me just think. A couple of things they mentioned about. BETRS. Yeah, so the Amazon Bedrock is more flexible way to deploy generative AI, and then the coding competitor, Code Whisperer, so which is a competitor to basically Copilot for GitHub. So I think AI, it's fine, still way early, but the fact that AWS could be back into growth, market like that. So that's on Amazon. And then we are done with earnings. 20 minutes, done with all four. Sorry, I just quickly rushed through it. I'm not sure, how deep you want to go into each earnings. A lot of interesting questions. Okay, a lot of discussions. Super, their advertising business is doing amazing. Yeah, you're right. Not much priced. You don't hear analysts talking more about much about advertising, but it's almost like $48 billion run rate business. Now it says cloud is expensive compared to on-premise data center, which is recurring expense. There are two ways to it. Cloud is, again, at the end of the day, you'll show the TCO, and if you don't manage your Amazon instances judiciously, yes, it could become very expensive than having your on-prem data center. But if you look at overall TCO, I think cloud still wins over on-prem. People will build tools to manage their AWS expenses. But I agree with you. If you don't manage in our companies, two companies I work for, we had our engineering team build tools specifically to monitor our usage of AWS instances, and we were able to bring it down by, in first one, we were able to bring it down by $4 million per year. In the second one, it was almost $2 million. We had to build our tooling to make sure the instances are not left up and running, or how to effectively use the pipelines and all that stuff. Otherwise, these expenses could run big into huge numbers. But you don't have a hassle of servers and all that stuff. You can go and get whenever you need it, scale your business up and down. How much it costs to pay engineers there. All right, so that's it for today. Anything else? Any other questions? Any new stocks bought, sold? I didn't buy anything. Any new stock you're interested in that we have never talked about? Which stock you want to do, let's say, deep dive next week? How to avoid early assignment risk? Early assignment risk, keep an eye on extrinsic value left in the option. If the extrinsic, so here's my two things. Number one, extrinsic value. Number two, if it is an individual stock, dividend. So I think we talked about it in one of our previous session. Maybe I'll go and see which week was it, and next week maybe I'll send you the session, the recording link, so that the session number, and in which we actually talked about the assignment risk, how to identify the early assignment risk for both, dividend, if there's a dividend coming up, or if there's an extrinsic value. These are the two factors that will help you to know if you are at a risk of early assignment or not. Jay says, yes, short puts, I got premium at 3,414 DTE. Yes. So which expiration, Jay, you look at?
It's 13 days now, so Friday, yeah.
Number 23.
Way out. I got
Like a lottery.
105. I got 105. Well, it's naked, so
Yeah.
I like to be
How
far
much buying
away.
power does it consume?
$3,300. Let's see for you.
Why is it $32,000?
Mm.
Or maybe
Oh,
because
you
I've
have
never
10.
done futures.
No, you have 10. That's why. So each one is 3,300. So quantity 10 is 33,000.
Oh, 10.
Yeah.
Yeah, I've never done futures. So I've not dipped into futures yet.
Yeah, this is span margin. So
Yeah, I know it's from a March.
it expands on you if it goes down. If it stays level, that margin will keep reducing. And if you let it expire, it will end up being close to nothing. So each day it goes down.
And I know, every year I think, okay, this year I'll dip my feet into futures, but then I realize I have so many other things, I don't have to complicate. So I have not done it yet. It's been
maybe it's a smart thing.
I don't know. It's been like, say, I think 2021 or 2022. I thought, no, I'm gonna at least do some futures. I didn't do it this year. Also, I haven't yet started. And now, I mean, there are a lot of I really don't feel the need of doing it. Dash PayPal.
If you're doing trying to obtain negative delta by doing one contract of ES future calls will give you significant amount, and that should help out with your portfolio also.
Yeah, my only worry is the futures. There is a little more learning curve required from, when it expires, and there were wonky expirations. Different futures have a different expirations, and then you have a tick size, and there are stuff that I need to learn, those additional, which are very specific to futures, right? So that is what has kept me away yet. And I'm like, okay, I'll do max, then I'll do SPX.
You won't learn swimming until you get into the water.
Yeah. I mean, I haven't felt the need that I've exhausted my buying power, because I think throughout this year, I don't think, and I'm generally very conservative. So I don't think I've used more than 30 or 40% of the buying power available to me. So I didn't have to, I never felt the need to scale it. Dash, PayPal. Okay, yeah, maybe we can do PayPal next week. MBLY. Let me just note down this MBLY. MBLY PayPal dash. Okay, yeah, PayPal. Rajesh, I'm a fresh participant and found it informative. Welcome. Thanks for joining.
Thank you, Vivek.
Hopefully, yeah, we meet every Saturday unless I cancel it on Meetup. So, same time, 10 a.m. Pacific. Where are you joining from?
Detroit.
Okay.
Ramesh Ji Bajaj got me
Okay.
introduced to you.
Got it. Yeah, he's been an OG. He's been here for what, 3.5 years? Yeah. So no, thanks for joining. If you have any specific questions, feel free, ping in the chat.
Sure.
Cool. All right, that's it. Shribi, I am taking a screenshot of this and probably take a rain check for now and use it when I need to. Thank you for offer for helping with futures. All right, guys, I think that's it for today. We'll meet again next week. Bye-bye.